Why is the mortgage interest rate at an all-time low? The mortgage interest rate is at an all-time low due to slow post-Great Recession growth, the Fed's response to the COVID pandemic, and subsequent adjustments based on inflation. The mortgage interest rate has hit an all-time low primarily due to a combination of economic factors. Following the Great Recession, the Federal Reserve opted to maintain low interest rates to stimulate economic growth. This prolonged period of accommodative monetary policy kept borrowing costs relatively low, including mortgage rates. The situation took a drastic turn in 2020 when the world grappled with the COVID-19 pandemic. To counter the economic fallout, the Federal Reserve swiftly slashed interest rates to near zero levels. This move was aimed at encouraging borrowing, investing, and spending to boost the economy. Consequently, mortgage rates mirrored this trend and reached remarkable lows, with some surveys recording rates as low as 2.93%. However, the narrative shifted with the resurgence of inflation. As inflation began to surge, the Federal Reserve adapted its approach. In response to rising price levels, the Fed signaled a departure from the ultra-low interest rate environment, initiating discussions about potential rate hikes. This change in stance was a testament to the dynamic nature of economic conditions and the central bank's commitment to maintaining a delicate balance between growth and inflation. What is the lowest mortgage interest rate in history? Google snippet. The lowest mortgage interest rate in history was 2.65%, recorded in January 2021, according to Freddie Mac. The record for the lowest mortgage interest rate in history stands at an astonishing 2.65%. This historic low was documented in January 2021, as reported by Freddie Mac, a prominent player in the mortgage market. The 2.65% rate for a 30-year fixed mortgage represents a remarkable benchmark, reflecting the extraordinary conditions that prevailed in the wake of the COVID-19 pandemic and the subsequent monetary policy responses. This unprecedented low in mortgage rates served as a testament to the extraordinary measures taken by central banks, particularly the Federal Reserve, to stabilize and stimulate the economy during times of crisis. Borrowers, during this period, were afforded a unique opportunity to access financing at historically favorable terms, facilitating home purchases and refinancing at levels rarely seen before. It's crucial to recognize that this lowest recorded mortgage interest rate was not an isolated event but rather a culmination of factors, including the Federal Reserve's commitment to low interest rates, economic uncertainties, and the unique challenges posed by the global health crisis. As economic conditions evolve, these historic lows highlight the adaptability of financial markets to unprecedented challenges and the critical role of monetary policy in shaping interest rate landscapes. Why were interest rates so low for so long? Interest rates have remained persistently low for an extended period due to a decline in expected inflation. Since around 2010, there has been a noticeable downward trajectory in inflation expectations, dropping by approximately half a percentage point. This decrease in anticipated inflation has been a significant factor influencing the Federal Reserve's approach to monetary policy. As far back as May 2011, expectations for inflation over the next decade were above 2%. However, economic dynamics, including subdued inflationary pressures, prompted a reassessment of the trajectory of interest rates. The Federal Reserve, in response to these evolving conditions, chose to maintain a stance of accommodative monetary policy. By keeping interest rates low, the central bank aimed to stimulate economic activity, encourage borrowing, and address concerns related to sluggish growth. The persistence of low interest rates was not solely linked to inflation but also reflected broader global economic trends. Weakness in global demand, geopolitical uncertainties, and the aftermath of the Great Recession contributed to an environment where central banks, not just in the United States but globally, leaned towards policies that favored lower interest rates.